Welcome everyone to Unshackled Savings Invest on Your Own Terms. My name is Leah with Sense Financial, and we are a boutique financial firm specializing in self-directed retirement accounts with Checkbook-controlled. Our presenter today is Brad Sininsky, and I briefly want to introduce Brad. He is a solo 401k and SDIRA consultant here at Sense Financial. He has a professional journey spanning over 18 years in real estate investing. Brett is also a licensed California real estate agent, and his passion lies in empowering people to attain financial independence, affording them the possibility of an early retirement. Thank you so much, Brad, for joining us today, and I'll let you take it from here.
Yes, thank you so much. Really appreciate it. We are going to talk about unshackled savings, invest on your terms, and the way that we're going to talk about that is through the two most popular ways of self-directing your retirement, which is the solo 401k and the self-directed IRA. But before we get into that, my information, just quickly, if you want to reach out, take down my name and email address, that's fine. We are not a fiduciary. We are not attorneys. We are not CPAs. If you need professional help of any kind in that sense, please reach out to the proper professional. If you need one, I'm happy to refer one over to you if I have one that I know that might be able to help you. So don't hesitate to ask. First of all, let's talk about why us. Well, we have been in business since 2010. We've set up well over 3,000 now, probably over 4,000 different clients for well over 4,000 different types of self-directed retirement accounts. And we have 5-star reviews all over the place. If you go to Google, you can search SenseFinancial reviews and see what comes up. I definitely encourage you to do that before you do business with any company. Reviews are abundant now, and those are third-party testimonials of clients who have worked with us directly and are current clients and maybe in some cases past clients as well that have given us reviews that you can check out. Our mission is to help clients obtain control of and protect their retirement accounts. Proverbs 21:5 says, "Good planning and hard work lead to prosperity." And you work hard for your money. We want to come alongside you and work hard for you as well in this capacity. So, without further ado, let's talk about the difference between conventional and self-directed. Well, conventional investing is like the bus. It's the city bus, right? It has a purpose. It serves a purpose. However, you have to get to the bus stop at a certain location at a certain time to get on the bus at a certain time and get off the bus at a certain time at a certain spot. And you have to walk or get a ride to the stop and from the drop-off or walk, either way. But it's kind of restricted, right? It has a certain route that it goes, certain stops at certain intervals, but it serves a purpose, right? It'll get you to a destination. That's the conventional side of investing, right? Think about investing with Fidelity or Vanguard or Schwab or even your employer-sponsored 401k plan. Nothing wrong with it. I definitely recommend doing that if that's the only thing you know. And you can do really well in it over a period of time if you continuously invest. And that's fine. But you have little control, right? If you're at Schwab, your money's at Schwab in an IRA or a 401k, for example, you are limited to what they offer, right? Stocks, bonds, mutual funds, and ETFs primarily. ETFs if you're lucky. So that's the conventional side. There's like $21 trillion in retirement accounts right now. It's wild. Many of those are not self-directed. Now, obviously, we're advocates for self-directing because you get control over your funds. And if you have control over your funds, then you can invest where you would like. I'm going to give some examples on the next slide, but the self-directed side of things, I was being a little humorous with this image here, but the self-directed side of things is like having an off-road vehicle that can not only go on the road and off the road, but it can even fly. And that's why those little helicopter propellers are there. By the way, I want that truck. I think it'd be awesome. But that's the self-directed side of things. It's kind of like the Wild West. There are some rules to follow, not a lot, but if you follow them, just like driving down the road and stopping at the stop sign or putting your seatbelt on, if you follow them, it can be a very effective way of investing because You can invest and get true diversification by, you could stay in the stock market with some of the money. That's fine. But when you unlock it with a self-directed retirement account, you can also invest in real estate, commercial, residential, tax deeds, trust deeds, private lending. You can invest in private placements, syndication, precious metals. You can invest in cryptocurrency. Your IRA, your 401k can be the bank, and you can loan money out to people and get a return, and you can do that over and over and over again. And what I want you to think about while we're talking through this is, at the broker dealer, Schwab, Fidelity, T. Rowe Price, Vanguard, wherever, even your employer 401k plan, there are fees built in. You may not see them. You may not realize what the fees are because they're coming out of the returns, or when you transact, maybe you'll see a fee, but it'll come out of the growth on the transaction. There are fees built in. Okay. With a self-directed retirement account, are there fees? Yeah, there's an establishment fee and an annual fee, all of which are flat fees, at least for our company. And so these are very small. Our annual fee is $250 a year starting in year number 2. And that doesn't matter how many transactions you do or how much money you have in the retirement account or how many assets you have. You could have 100 houses or 4 houses. It's the same fee. $100 or $100 million, it's the same fee. It's all flat. That's not so inside of a broker-dealer account like Schwab or Vanguard. The fees are based on how much money you have in there and invested. So think about this. If you get a $1,200 rent check from a rental property, or a $1,200 payment from a fix and flipper that you loaned money to, that whole $1,200 goes back into the account, and you can invest the entire $1,200. So if you do this for a decade or more, you can really have a lot of money from self-directing. Plus, you get the control in investing and the ability to invest in what you know, right? People ask us all the time, what should I invest in? And I say, well, I don't know. What do you know? What are you comfortable with? Well, I've been a hard money lender for 20 years. Well, that's probably something you should consider doing with your retirement account. You know how to do it. You know how to mitigate your chance of getting burned by doing the proper due diligence on the person you're loaning the money to. You know how to originate the loan. You know how to get the documents properly vetted. You know how to check title. You know how to get on there at the right lien position, first or second or whatever. You know how to do that. Okay, well, do that in your retirement account and you have full control. The other thing is, 2 people are signing on the dotted line for what those returns are going to be, what the terms are, the amount of the payment, the amount of the interest. Okay. Is there a balloon? No balloon. Points up front? No points? Whatever. You do not have that kind of control in the stock market. You literally just give your money up to the S&P 500, and whatever happens with those 500 different companies in the country happens. Right? You have no control over Tesla or Apple or any of these other Fortune 500 companies. Can you do well there? Yes, you can. I already said that at the beginning. Is it the best way to do it? I don't think so. I think what we're talking about is much more effective. But again, true diversification, have money in the stock market, S&P 500, and have money in real estate or crypto or precious metals or private lending, whatever you are comfortable with. We are not here to provide investment advice. This is a self-directed method. You are the self. Ecclesiastes 11:2 says, divide your portion to 7 or even to 8, for you do not know what misfortune may occur on the earth. And so, does this provide true diversification? Dividing your portion around? Yes, it does. Here's the 2 options, the self-directed IRA and the solo 401k. Essentially, the self-directed IRA is for just about anybody, right? That's why there's so many people in that photo. The solo 401k requires somebody to have legitimate self-employment activity. Okay, so it's for the business owner and their spouse primarily. How does the checkbook IRA work? First, we're going to go through this and the difference between a basic IRA, basic self-directed IRA, and checkbook IRA, and then we're going to launch into the solo 401k. And then I have a special guest coming on to talk about his experience as a Sense Financial client with a solo 401k and what he's doing with it. And so stick around for that. It's going to happen in about 20 minutes, give or take. So first of all, when you have a basic IRA, there has to be a custodian, regardless of basic or checkbook or whatever. There's always a custodian with the IRA. Okay. Now, with the basic IRA, before I continue on this slide, We don't do these, by the way. This is not what we do at Sense Financial. We believe that a checkbook style IRA is a more efficient way to invest and manage your account, which you'll see here in a moment. But the basic self-directed IRA requires you to go through the custodian for all transactions. Okay, maybe you're listening to this call, the recording, or you're on here now, and you have a basic self-directed IRA and you're going through the custodian for all transactions, and you're doing private loans, or you have a rental property, and you know the challenge that it creates to log into their portal and request that a bill be paid, or to log into the portal and upload a purchase agreement and have the custodian sign it for benefit of your IRA. You know how long it takes to go back and forth with that custodian. You know how long it takes to get the money requested and the wire actually happen from the custodian to the borrower, or to the property manager, or to the title company for closing for that rental property that your IRA is going to own. Actually, your IRA owns it, but it's held by the custodian. Title is in the name of the custodian for benefit of your IRA. That's not how the checkbook IRA works. So with the basic IRA, there's transaction fees, there's a higher annual fee. Typically, there's a little bit less of an initiation or initial startup fee because the setup is less complicated, but they make up the difference in the annual fees and the transaction fees. Trust me on that. They can add up to thousands of dollars in some cases. At the very least, about $450 is about the minimum that I've seen per year. Okay. Again, remember I said our annual fee is only $250 flat per year. Okay. And then we do have our initial establishment fee, which varies by product, but it more than makes up for it over the course of a couple of years, 3 years, or give or take, compared to a basic IRA. So let's talk about the checkbook IRA, which is what we're big fans of. Now, first off, a new custodial account has to be opened up. This is not Schwab, that's a custodian. This is not Vanguard, they're a custodian. This is a custodian that allows for alternative asset investing. Okay, so that's the first thing. Second thing is a qualified transfer from the current custodian to that new custodian is actually set up. Okay, now the transfer can come from an IRA, it can come from a 401k, it can come from a 403b, 457, any retirement account. This could be Roth or traditional, or you can do both. Now, they're two separate plans. If you have Roth and traditional, they don't combine into one. They're two separate IRAs, but you can self-direct both of those different types of funds. So once you do that, the next step is actually creating what's called a special purpose LLC or special purpose trust, depending on your situation. But this special purpose document, this is not like a living trust that you have. This is not like an LLC that you have for your business. This is actually a special purpose document that in its agreement, in its operating agreement and trust documents, if it's a trust, outlines who you are, which is the manager of the LLC, and the IRA is the owner, or the trustee of the trust, and the IRA is the only owner, and of both, by the way, the LLC and the trust. The IRA is the only owner. You're the manager of the LLC or the trustee of the trust, and then also it lists out what the prohibited transactions are and the disqualified parties, and it has to be IRS compliant from that perspective. Now, as the manager of the LLC, that's where all the assets are actually held, okay, or the trust. All the assets are in this entity, okay? The IRA is the owner of it, but everything's inside of it. And that's how you have the checkbook control. So this special purpose document actually allows us to bypass the custodian. We can't eliminate with an IRA, but we can bypass, which allows you to invest much more easily than going through the custodian like I laid out a few minutes ago. You can actually open a bank account. You will, in this situation, you'll have a bank account in the name of the LLC or the special purpose trust, and this bank account will have cash in it. And then once you want to invest that cash from the rollover or contributions, you can actually just write a check or do a wire transfer, or you can do online bill pay. You have a debit card, checkbook, whatever. Okay, so it's really simple. It's just like you investing your own money from a checking account. It's just you're doing it on behalf of your IRA. Now, once that's set up, all the money goes into and out of for investments that checking account. Okay, So that's how that works. Now, the annual contribution limit is $7,000 a year for an IRA if you're under 50, or $8,000 if you're over 50. Okay, so you can make IRA contributions on top of 401k contributions. They're two separate plans, so I want to be clear about that. Now let's move on to the solo 401k. As I talk about the solo 401k, there are a lot of similarities about the solo 401k and what it can invest in, just like the IRA. So I'm going to spend more time on the solo 401k, and I'll try to point out where the crossover is. Okay. So if I don't say this works the same in both plans, that means I'm only talking about the solo 401k, like this entire slide for the most part. So how does it work? Well, first off, I already said at the beginning that you have to be self-employed to have a solo 401k. Now, before you jump off and you're like, I'm not self-employed. Well, hold on a second, because you'll learn something new that you didn't know. And it's not hard to become self-employed. Okay, you can be a sole proprietor, corporation, LLC, partnership. It all works. You can file taxes as an S corp, C corp. It all works. Now, you can't have any employees, no W-2 employees, no full-time W-2 employees outside of yourself and a spouse or any business owners. Okay, if it's a partnership. Now, you could drive for Uber one day a month and be self-employed. I have my real estate license. I've had it for a long time, but I can sell one house, just as an example, every other year, and I'm self-employed. Now, it's all about the intent, right? I'm in business to make money, okay? I'm buying stuff at garage sales to sell that stuff on eBay or an Amazon store or my own garage sale or whatever, because I'm in business to make money, okay? So I'm in business. I'm self-employed, right? Those are just a couple examples. I could join a network marketing company and do that. I'm self-employed. If I earn money, I'm going to get a 1099. I'm an independent contractor. I'm probably going to do that as a sole proprietor, but maybe not. Consult your tax advisor before doing anything like this. But the legitimate self-employment activity is required. Okay, this is not passive income. If you're living off rental income, that does not work. You could potentially create a property management company to manage those rentals so that now you have this property management company self-employed, right? Even though it's your own rentals. I shouldn't even do quotation marks because you really are self-employed at that point. You can have a solo 401k plan. Again, consult your tax advisor. Now, once you establish, okay, I'm self-employed, that's the plan sponsor, right? So that sponsor adopts the plan, the adoption agreement, and the plan is created. And then you, as the trustee, again, just like the IRA, all the assets are inside. With the IRA, all the assets are inside the LLC or the trust. With the solo 401k, it is a trust. And so with the solo 401k, all the assets are in the trust. There's no custodian requirement for a 401k, so there's no need to bypass the custodian. You can just have checkbook control directly at the solo 401k trust level, which makes you the plan trustee. So the 401k is its own entity. You're the trustee, right? You're the fiduciary of both of these types of plans. Your job is to invest the money, invest it wisely, aggressively, but also to make the best decisions possible for the plan. It's not your money. You're just basically managing it for somebody else, for another entity, even though you're the beneficiary of the money down the road. Now, this trustee power gives you the ability to open a bank account at any financial institution or brokerage. All the money goes into that account. If you do a rollover, that's fine. You just like the IRA, you can roll existing retirement account money into the 401k. You can make contributions to the solo 401k from the self-employment activity business. Once you establish the bank account and the money's in there, you're ready to self-direct. Okay, so it takes a few weeks or so to set up a self-directed IRA, the checkbook IRA, but it only takes about a week to set up the solo 401k. And for both, you should plan on 1 to 2 weeks-ish. Sometimes it's quicker, but 1 to 2 weeks for any rollovers from other plans that you're doing, okay? It depends on the custodian. It depends on challenges around that or paperwork required and how long they take to act and respond to what you ask for. But 1 to 2 weeks is a good plan on that. So inside 3 to 4 weeks, the IRA can be all set up. And inside of a couple weeks, maybe 3 at worst case scenario. The solo 401k is all set up, the money's in there from the rollover, and you're ready to self-direct, at which point you can do that. All the income and expenses go into and out of that checking account for the investments, just like the IRA. One more thing to note, actually, I'm going to hold off on that. Here's the contributions. So unlike an IRA, which has a $7,000 contribution limit per year, the 401k, the solo 401k actually is 10 times that. It's actually $70,000 per year if you're under 50, okay, per participant. So if you're married, you can double this. And if you're over 50, but between over 50 up till 60, you can contribute up to $77,000 a year. $77,500 actually, because there's a catch-up contribution. If you are if you're between 60 and 63, you can actually go up to $81,250 because there's a super catch-up. Once you're past 63, then it goes back to the regular catch-up. Okay, this is part of the Secure 2.0. Don't ask me why between those ages. I don't know. I have a slide that breaks that down a little more effectively, so you can see it here in a few minutes. But somebody threw a dart at the wall and said, "Hey, if they're 60 to 63, we should let them put in more money." I don't know. The wise man saves for the future, but the foolish man spends whatever he gets. Proverbs 21:20. That's right. Save for the future. Okay, so the contributions work a couple different ways. You have being self-employed, you have a bucket for being the employee, and you have a bucket for being the employer. Okay, so as the employee, you can actually contribute up to $23,500 per year. This is 100% of your self-employment earnings. So if you make $50,000, actually, let me back up. If you make $24,000, you can essentially put in $23,500, right? Now, this is money you don't need to live on, but that's my point is you could put that much into the IRA or 401k, excuse me. Plus, if you're over 50, that $7,500 catch up, or more if you're between the 60 and 63. Now, if you're an S corp or C corp and you're running payroll, you actually have to. Everything is based on the W-2, right? So the employee contributions actually have to be made through payroll. Okay, they can be pre-tax or Roth. It's totally up to you, or a combination. Now, the profit sharing is 25% of the profit of the company if you're a sole proprietor, single member LLC. If you are, sole proprietor. If you are, 20% for sole proprietor, single member LLC. If you're S corp or C corp, you're running payroll. It's 25% of the W-2 for the year. So simple math. If you put in $100,000, if you have a W-2 of $100,000, then you can contribute 20. If I'm under 50, I can contribute $23,500 plus another $25,000, right? 25% of the 100 to get to. That's how I get to my max. Now, the maximum is 70. Now, in my $100,000 W-2 example, I'm not getting there, so the W-2 would have to be higher, but you can do a reverse engineer on the math to figure it out. So again, it's $70,000 per year if you're under 50. If you're ages 50 plus and 64 plus, $77,500. If you're between the 60 and 63, it's that super catch up with the $81,250. That just took place this year. That was not available for 2024. By the way, it's not too late to contribute to a 401k if you have not filed your taxes yet. It's April 17th. If you haven't filed your taxes yet, if you extended, then you can still contribute. Now, there's some nuance to it. If the plan wasn't set up, we can backdate it in certain situations so that you can contribute for 2024. If you're S corp for 2024, again, everything has to be done through payroll. So at this point, your only ability would be, if you're S corp and running payroll, your only ability for 2024 would be to make a profit sharing contribution. Sorry, I got a little tickle in my throat there. Okay. So that is that. Now, you can get a loan, okay? You can get a non-recourse loan for the retirement account. This applies, by the way, to both the IRA and the 401k. You cannot provide a personal guarantee. The loan must be non-recourse, which means that you can't provide a personal guarantee. It also means the property is the only security for the loan. So if my IRA or 401k defaults in the payment, the only thing that the lender can go after is the property. They cannot ding my credit or file a judgment against me personally. I did not personally guarantee the loan. Why? Because I am a disqualified party. We'll talk more about that in a moment. The property needs to cash flow. It's a little bit of a higher risk loan, right? Because there's no personal guarantee. It's a higher risk loan for the lender, so it's going to require more down, typically 30 at minimum, usually closer to 40 or 50% down. And the property's got a cash flow. It's got, a couple $100 a month, give or take. You also have to have cash reserves. Usually 6 months is what they want to see in the plan, by the way. So if this leads me to rollovers, right? If you know what you're going to invest in, if you're going to invest $50,000 in a private placement, don't just roll over $50,000. First of all, you have a checking account. You don't want zero in the checking account anyway, at least $1,000, maybe 500. But if you're going to buy a rental property, if you're going to get a loan, that's a whole nother conversation. But if you're just going to buy it with cash, you still need some cushion in the account. If the property is $50,000, you should probably roll over like 60 or 70 to have some cushion for unexpected expenses. Now, if you have a retirement account outside of the self-directed, down the road, you can roll more money in. So there's no limit to the amount of rollovers. But if you expect to incur expenses right out of the gate, or even with a rental property, it's going to happen unexpectedly. You should have a few $1,000s in there. You can always roll more in. But again, remember I said plan on 1 to 2 weeks for that rollover. So if you need money right away, that could pose a problem for you. Sorry, I keep getting a little tickle. Hold on. That could pose a problem for you. So make sure that you are planning for that. Okay. Now, there is a UDFI tax, unrelated debt finance income tax, for IRAs when you have leverage. Okay. So bear that in mind. And then we do have a list of non-recourse lenders here that you can go to, SenseFinancial.com /non-recourse lenders. Leah is our special guest in the house.
Currently, we're still waiting for him to arrive.
All right. Would you do me a favor? I'll keep going, but do me a favor and email him. Actually, let me shoot him a text real quick as well.
Mm-hmm.
But yeah, please email him, and I can come back to this. Include the link in the email too, please.
Yes, sure.
Okay. All right, let's come back to that. I'll keep going for now. All right, so here is a chart of the difference between the self-directed IRA versus, that's the basic IRA that I was talking about, versus the IRA LLC versus the solo 401k. So they all provide access to non-traditional, non-Wall Street alternative assets investing. Okay, so they're even keel there. Now, there's always a custodian for the IRA. We talked about that. You can have checkbook control with an IRA LLC, IRA trust, or solo 401k, but not with the basic self-directed IRA. You're going through the custodian for everything. There are transaction fees with a basic IRA because you're going through the custodian, so they charge less up front, and they charge you a bunch of fees ongoing, forever, by the way. Sometimes they're per asset fee as well. So if you have a few different loans in there, a few different properties, there's a fee per asset, usually like $100 per asset plus, like a $50 per transaction fee and that sort of thing. So they can certainly add up. Our $250 flat annual starts to look really attractive when you compare it, even though the upfront for the checkbook control is a little bit more. Now, we didn't talk about this, but I'll talk about it now. There is no personal loan option with an IRA. Now, let me back up a little bit on that, because if you have a Roth IRA, you can actually, if you make straight Roth contributions, these are after-tax contributions, right? You can withdraw that money tomorrow, anytime. Not so with a Roth conversion. There's a 5-year rule on the Roth conversion money, even the money that was converted, but definitely there's a 5-year rule on all the gains. Okay, so if you're doing Roth conversions, just bear that in mind. But if they're straight Roth contributions, the Roth IRA could actually act as like an emergency fund for you, because you can withdraw those anytime. Now, the LLC fees, yes, of course, with any LLC, there's going to be fees depending on the state that you file it in. And then the personal loan, let me go back to that. Sorry, I lost my train of thought. With the solo 401k, you can actually borrow up to $50,000 or 50% of the total plan value, whichever is less. And then you can actually pay that back over the course of 5 years. You can use this for any reason. Over 5 years, interest rate of prime plus 1%, or 15 years if you use the money to buy a personal residence, primary residence only. Okay. Again, interest rate prime plus 1%. Now, there's no UBIT or UDFI on leveraged real estate for the solo 401k. UBIT is unrelated business income tax. So this tax actually will apply in both the 401k and the IRA for running an active business. You see, the plans, these retirement accounts are designed to be invested passively. So if they own a business like a dry cleaners or what was the company I heard? Buffalo Wild Wings? I guess that was what it was called. Buffalo Wild Wings. There was somebody who had a self-directed IRA that was a part owner, the IRA was, in these Buffalo Wild Wings. Now, they're making a ton of money, right? But all the income is subject to this unrelated business income tax, which scales up to 37% once you get to about $16,000 of income for the year. You can deduct expenses and depreciation if it's rental property and such before that amount is calculated. But it's still there, and it scales up to 37%. You can lower that to the corporate tax rate of 21% by setting up a blocker, what's called like a blocker C corporation. So you have the IRA LLC, and then the C corporation, and then the business is inside the C corporation, and so it kind of blocks it from that 37%. It's still 21%, but it's a way to kind of reduce that. That's not something that we can set up here at Sense Financial, so you'd have to seek out a tax advisor or attorney for that. But it is possible if you really, really wanted to own an active business inside your IRA or 401k. What the solo 401k is exempt from only is the UDFI on the leveraged real estate. Okay, so if you have a loan on a property in the solo 401k, there's no UDFI. If you have it in the IRA, there is. Now, the max contribution differences we talked about, the super catch-up we talked about, the built-in Roth. Okay, this is something we didn't talk about much at all, actually. An IRA is either Roth or traditional, but it's not both. The solo 401k has both Roth and traditional funds built into it. Now, just about any type of retirement account can directly roll into a solo 401k. With one exception, and that's the Roth IRA. If you want to self-direct a Roth IRA, it actually has to become a self-directed Roth IRA only. Okay. Now, if you have Roth 401k funds, those can move into or roll into the solo 401k. That's fine. It's just the Roth IRA that can't. Okay. So when it comes to having the Roth funds and traditional funds built into the same plan, you actually, with the solo 401k, it means that you can make Roth or traditional contributions. You can have both of those types of funds in there. If you do Roth conversions, traditional money or traditional assets to Roth assets, you can do the conversion that way. And it's much easier in the solo 401k because it's all in the same plan as opposed to having one Roth IRA here and one traditional IRA here. It's a little more complicated, more fees, more to deal with, etc. But it's possible to do. And people who aren't self-employed, that's their option. That's what they do. Super catch-up only available with the 401k, of course. Built-in Roth, we just talked about that. And then, of course, the self-employment requirement. So, Leah, any word?
I've tried connecting. However, we haven't received a response yet.
Okay, no problem at all. I will just, hopefully everything's okay. Let's see. Check my email too. All right, well, that's all right. I'll go back and I'll just talk about him, even though he's not here. So hopefully everything's okay with Avery. He was going to join us today on the call, but he's not here yet. Maybe he'll pop in. Maybe he won't. It's okay either way. Avery actually came to us about maybe 10 months ago, and he wanted to set up a solo 401k. Well, let me back up. Avery does hard money lending. That's his business. He lives off of it. That's his primary source of income. J&R Capital LLC is his hard money lending business out of the Boise, Idaho area. And he used that to actually sponsor that business, to sponsor a solo 401k plan. So we set up a solo 401k plan. Now he primarily does investing, hard money lending, not only with his personal funds, but also his solo 401k funds. So he kind of does both. He does have some experience in private lending and real estate investing, which I would ask him more about if he were here. And then from a real estate investing perspective, his focus has been on RV and mobile home parks. And he loves the outdoors. He's a family dude, and he lives in Idaho. So no better place to enjoy the outdoors from what I've heard. I've not spent a lot of time in Idaho myself. But if he pops in the next few minutes, we'll go down the rabbit hole of talking to him some more. But anyway, with that, I will offer this. If anybody wants to jump on my calendar, you can visit my consultation link, SenseFinancial.com/consultation. And you're more than welcome to schedule a time that works for both of us. No phone tag back and forth. We'll talk about your goals and what makes you feel like you want to take control of your retirement account and what your goals are and how we may fit into them and answer any questions from that perspective. At this point, let's take some questions if there are any. Miss Leah, do we have any questions?
Currently, from the chat, we do not have any questions. However, we did have this question submitted earlier.
Okay.
So we have a question here. Can I set up multiple solo 401ks for one person?
Oh, great question. I love it. You actually can. Now, the way it works is you can't have one business sponsor or adopt more than one solo 401k plan. One business can only have one 401k. However, if you have multiple businesses, let's just call it two for simplicity, you can have two separate solo 401ks. The nuance is that you cannot double dip on the employee contribution. Okay, so that $23,500 or $31,000 if I'm over 50, I can't double dip on that employee contribution, but I can double dip, so to speak, on the profit sharing. So if my businesses are making enough money, I can go all the way from 0 to 70,000 or 77,500 with just the profit sharing, just the 25% of the W-2 or the 25% of the profit of the company. Again, it's got to make sense. In some cases, it might make more sense to just run two separate businesses through the same LLC. You've got to talk to your tax advisor about that, and that way that one LLC can sponsor one solo 401k plan, and you can maximize the contributions with one plan instead of having to set up two. But the short answer is yes, you could technically have two separate plans. Any others?
Right, thank you for that, Brad. There is one more. The question is, can I use my solo 401k to buy real estate? And if yes, how do I do that?
Oh, good question. Yes, we covered that a little bit, but let me add this. You know what? I didn't get into the disqualified parties and such much. I should talk about that real quick. So the IRS doesn't actually tell you, and I'll circle back to the question, I promise. The IRS doesn't actually tell you what you can invest in. There's no such list. They tell you what you cannot invest in. And there's 3 things, okay? 4 things, really. Collectibles, okay? Baseball card stamps, wine, cars, that sort of thing, antiques. That's for both plans. Life insurance in an IRA. Cannot invest in life insurance with an IRA. There are ways to do that. There is a way to do that with the solo 401k, but most clients are not looking to do that. Most people are looking for alternative assets like real estate, as an example. And then S corporation stock, because you have to be a person, a human, to invest in S corporation stock. So an entity can't do it. So IRA 401k does not work for S corporation stock. And then don't misunderstand me. An S corporation can be an adopting business of a solo 401k, but it just can't invest in another company S corporation stock. And then the other one is the disqualified parties. Okay, so 4 altogether. Who's disqualified, and what does it mean? Well, you and your immediate family. You, your spouse, your parents, your grandparents, your children, their spouses, and your grandchildren. You know, those your immediate lineal descents. So that means I can't invest in a property or a company, rather, that any of those people have a majority ownership in. I can't buy a property from any of those people, myself included. My IRA cannot buy a property from them. Okay, that's self-dealing. You can't do that. You also can't provide services. So an easy way to think about it is white collar is okay, blue collar is not. I can hire the person that swings the hammer, but I can't swing the hammer myself. All right. So let's go to the real estate investment question. By the way, that was a real high level on disqualified parties and prohibited transactions. Don't do it. The fees and the penalties are erroneous, especially with an IRA. If you have any questions, by the way, we offer unlimited client support for our clients. And one of the main topics that comes up is, can I do this? Is this a prohibited transaction? So ask the question before you do it. If you have another provider, ask the question. If they don't have the ability to service a question like that, then you have the wrong provider. You need to switch. But I digress. Regarding purchasing real estate inside of your retirement account, think about doing it personally, but insert the retirement account into the equation instead of you. When you have checkbook control, you can sign on the dotted line. Title is taken in the name of the LLC or the trust, not you personally, but you're still signing on behalf of everything. You're initiating the transfer, the wire transfer. You're initiating the payments for things like appraisal, home inspection, down payment and closing costs. You're initiating all this stuff. Okay, that's the beauty of this with checkbook control. And so that's essentially how you would do it. Now, on the disqualified party thing, while technically you could manage a property that your IRA 401k owns, it's probably best to just have your third-party manager do it. Somebody who's not a disqualified party. That way there's no restriction to what services they provide, and they can go take photos and they could process evictions and, go fix a leaky toilet or whatever. Okay. So it's probably best. And technically you could manage it yourself if it's just collecting money and answering questions from the tenant. Again, blue collar, not okay. White collar is okay. That's the line there. So, all right, what else we got, Miss Leah?
All right, those were actually the last question that we have for today. Maybe you would like to add anything else before we conclude the webinar?
Well, just our contact info. If you want to contact our office, you can contact them there. If you want to get on my calendar, SenseFinancial.com/consultation. And then all the way at the beginning, if you want to contact me directly, my information is right there on the screen. And otherwise, I think that just about wraps it up. But Leah, I appreciate your time. Thank you so much to you and everybody else who joined.